All right, for more markets coverage here, let's get some insights out of Bryce Doty. He's Senior Portfolio Manager at SIT Investment Associates. Bryce, always wonderful to see you here. It's obviously been a pretty tough start to the year for equities and for most risk assets here. I'm wondering if you see a silver lining in any of this with regards to, I guess, not only the pullback, but how some folks are interpreting the tea leaves with regards to the economic policy, monetary policy going forward.
Well, I think there are some silver linings to what's going on. I think the Fed kept rates too low for too long and was printing money for too long. They're injecting $1 trillion a year into the markets, and so that was suppressing bond yields. And a lot of that money we can see from flow of funds has propped up the stock market, and so it'll be nice to have that kind of artificial factor taken out of the markets. I think it's a healthy thing. So it's not fun, but we're talking about silver linings, which means, you know, the main thrust is maybe some bad medicine to go down. But I still think it's the right thing to do to let markets kind of find a natural level that they should be at without the Fed injecting so much money into the system.
So you're not buying the dip quite yet? Have they found that level?
No, I was firmly in the buy the dip camp all year last year. I have said farewell to that camp. There's just too many headwinds out there. I think, like right now going into the close, you've got the market looking at tomorrow's CPI numbers, you know, staring them in the face, and it's impressive that it's come back as much as it has. Because I think tomorrow's inflation number is just going to remind everyone that inflation is alive and well. You're seeing the 2-year react to that. You mentioned that's up to 0.9%. That's because it's saying, well, inflation is strong. The Fed is just going to start raising rates. And we think, you know, Fed funds should be 1% by the end of the year. That means the 2-year has to climb a lot more than even 0.9. And the more rates go up, the worse that is for stocks.
Yeah, given your expectation on inflation here this week, are there mispriced opportunities in the market? Meaning, are there areas where investors may lose money going into this week because of where they're betting?
Definitely. Bonds. I'm bond manager and I'm nervous. I mean, it's going to be tough with rates going up. I think there are some buy the dip opportunities, you know, out there perhaps. If you think Omicron is going to roll over, this wave is going to sweep through us and come back down like it did in South Africa, then maybe, you know, you take a flyer on some, no pun intended, sorry about that, on travel. I can't name names, but, you know, an ETF would be a way on that. Other places, though, could get hurt, you know. Retailers, ironically, are just doing extremely well with the inflation. They've been able to expand margins if they can keep their stores open, as you mentioned with Lululemon. So there are some winners and losers that are going to shake out of this, but just on a broad basis, I'm out of that by the dip camp.
What about, I guess, so some of the broader sort of cyclical trades that a lot of people sort of bet on, I think, early in 2021 and in 2020, and they kind of abandoned them after a while, I guess, when they got a little bit of skittish here about the economy. I mean, by all economist estimates that we have here at Bloomberg, we're still going to see relatively healthy GDP growth, at least here in the United States.
Well, how much of that do you think is inflation? Because the GDP number, you know, the earnings and whatnot are not inflation adjusted. The GDP number is, but if you have, you know, a 10% growth in profits and year-over-year CPI was 7, you're able to improve your pricing in relation to CPI. You really only had 3% growth in earnings, but the stock market doesn't care. That stock market looks at the top line number, and it's like, so then you get a disconnect between the inflation-adjusted GDP and what earnings are telling you. Now, those are going to start to converge, you know, coming up here, and you have the headwinds of the Fed tapering. The Fed balance sheet was $9 trillion. I mean, it's a rounding error. It's just below that. But just imagine what that does to suppress yields and prop up the stock market. With them, you know, they're going to taper a little bit and let bonds start to roll off. That's going to be tiny. But it is, you have to keep in mind that $9 trillion is a big deal. And then the fiscal stimulus is tapering, and then people's savings are tapering. I mean, it'll be interesting to see just how much people spent in December relative to what they earned. So those numbers will be coming out pretty shortly as well. So those headwinds, are just something you have to keep in the back of your mind as you look at these massive earnings that are probably going to be coming out soon.
I mean, Bryce, you're a man with real expertise and focus in the fixed income area. I want to go back to your leaving the buy the dip camp of late. What about whether there's a level that yields just won't really push higher than? We saw it just touch 1.8% on the 10-year today, for example, and then the buyers did come in to a certain extent. Yields are still higher on the day, but far less than they were. Is that foreign pool of money as well just still there to keep a certain bandwidth in place?
Yeah, that's a good point. I think there is a lot of foreign money that loves the yields that we have here, and it does keep a cap on some of the rates. But as you pointed out, there's a lot fewer foreign bonds at a negative yield. So that dissipates a little bit. That allows the 10 and 30-year yields to go a little higher than you might expect. I'd say a cap on the 30 years around 3%. I believe that the short end goes up quicker. The more the Fed appears to be doing something about inflation, the happier 30-year Treasury holders are. They're like, okay, it'll be less damage. But the concern is that the Fed won't be able to affect inflation. They're raising rates and whatnot, but that doesn't get people back to work. Normally it does, but we need to wait until people's savings are burned out or something has to change before we can really expect that the Fed not buying bonds is going to do anything about people showing up for work at Lululemon.
Bryce Doty, love how you always weave in what's happening in the here and the now to the longer-term portfolio perspective. Senior Portfolio Manager over at SIT Investment Associates. Stay well. Come back soon. Meanwhile, coming up, we're going to be talking...